Hello, everyone. I've received a few questions on the flow of the financial statement, so I thought that I would put together a quick video to kind of walk you guys through Exhibit 8 from Chapter 1. Okay, so first we have four primary financial statements. Okay, we have the income statement, we have the statement of equity, we have the balance sheet, and we have the statement of cash flow, and they are generally prepared in that order, and we'll see why in just a moment. All right. So let's start with the income statement. First of all, the income statement is always prepared for a period of time. It might be a certain month, a certain quarter, or a certain year, but it's always for a period of time. The income statement only shows two types of items. Revenue, in this case, they're calling it fees earned. Sometimes you'll see it actually called revenue. Sometimes you'll see it called sales. Either way, it's revenue, okay? It's what we earn doing whatever we're in business to do, okay? So the income statement shows revenues and expenses. That's it. Those are the only items that will be shown on an income statement, revenues and expenses. We can take our revenues minus our total expenses, and we arrive at net income. Now, don't worry too much about the double underlining here. I've received a question on that as well. The double underlining is just it's just a way in accounting that they normally somewhat notate the bottom line or the important total on a given document. But, you're certainly not going to, lose any points if a double underlining is missing or anything like that. So I don't want you to get too worried about that. But basically, our income statement shows our operational performance for a period of time. In this case, it's for the month ended November 30th, 2003, 2013, 2023. Can be any year that you like here, okay? But what we can see is we take our revenue of $7,500 less our total expenses of $4,450 gives us net income of $3,050. Now, we move to our statement of equity. Now, sometimes this goes by other names, especially this statement. Sometimes it's called the statement of retained earnings. Sometimes it's called the statement of stockholders' equity or the statement of shareholders' equity. That's why I normally just say the statement of equity, and we can use whatever name they are using in that specific chapter. But basically, our owner's equity is going to have two key components. One of those is what we call contributed capital. That means that is capital coming from the owners of the business. So it is money that they have invested in the business, normally in exchange for common stock. That is ownership in the business. Okay. Now, because this is a new business, the owner started out with a zero balance. He then invested $25,000 in the business. That was his investment. We add to that the net income for the period. We then subtract what they call withdrawals. If this was a corporation, we would call this dividends. It's basically money that has been taken out of the business and paid back to the owners. And that's something that we have to keep in mind. Even for a sole proprietorship, the business is a separate entity from the owner. That means we need to keep the finances of the business separate from the finances of the owner. So when we take $2,000 out of the business and give to the owner, that reduces the equity in the business. Okay, so to arrive at our ending capital balance, we take that beginning balance plus any investments from the owner, plus net income, or if this was a loss, if we had a net loss, it would be subtracted, less any withdrawals or dividends paid, and there we arrive at our ending capital balance. That ending capital balance is then going to be used when we prepare our balance sheet, okay? The balance sheet is where we prove that our accounting equation is in balance. The balance sheet has three elements: assets, liabilities, and equity. Total assets should always be equal to the total of liabilities plus equity. Our assets have three basic characteristics. One, they're an economic resource. Two, we own them. And three, they are going to provide some sort of future benefit. Okay, some of the most common examples of assets are going to include cash, accounts receivable, inventories, marketable securities, if we have investments in marketable securities, supplies, property, plant, and equipment, which we sometimes call fixed assets, intangible assets, which we'll learn about a little bit later in the course. Those are some common examples of assets. Okay, now we shift to the right side of the equation. Liabilities. These are basically our obligations to others. Normally, this is going to include money that we owe to other parties. Thus, anytime you see an account that ends in the word payable, if an account ends with the word payable, you know it's a liability. That is a red flag that it's a liability. It might say accounts payable. It might say taxes payable, wages payable, salaries payable, interest payable. Could say lots of things. But if it says payable, it's a liability. Now, as we're also going to learn in the course, it is possible for us to have obligations to others that we will not satisfy in cash. For example, we have a liability that is called unearned revenue. This is when customers pay us in advance, okay? They pay us the cash up front, but we do have an obligation to them. We have an obligation to perform work. That might be providing a service, that might be delivering a good, depending on what kind of business we're in, but we have an obligation to them. So if you see unearned revenue, that is also a liability. Now, down here to equity, in this case, we just took the ending equity balance here, the ending capital balance from the statement of equity, and we moved it down here into capital, and when we add liabilities and equity, we end up at $26,450, which is equal to our total assets. Now, as we progress forward in the course, your balance sheet is going to get more complicated because it's going to expand and you're going to see lots of other accounts in there. As we start to look at the balance sheet for corporations, you're going to see equity broken down specifically into common stock and retained earnings. Okay, so I just want to go ahead and point that out. So what we're looking at here is a very, very simple version of a balance sheet. It's a very, very condensed balance sheet for a very small company. As we start to look at bigger companies, we're going to see a lot more accounts on the balance sheet, and we're definitely going to start seeing a breakout in equity between that contributed capital or common stock and the retained earnings, which is essentially our accumulated income and losses since the inception of the business, less any money that has been paid out in withdrawals or dividends to the owners of the business. All right. Now, at this point, we're going to take a look at the statement of cash flows. I'm going to tell you right now, don't worry too much about the statement of cash flows. We are going to study the statement of cash flows more in depth. I believe that it's during week 5 when we study a chapter specifically geared toward the statement of cash flows. Now, you might be thinking, well, why don't we just study it now? The statement of cash flows, without question, is the most challenging of the financial statements to prepare. What you're going to learn after chapter 3 is that we can prepare our income statement, statement of equity, and balance sheet using an adjusted trial balance. The same is not true for the statement of cash flows. The statement of cash flows requires a much, much deeper analysis, and it requires more than simply a trial balance. And so for that reason, we're going to hold off a little bit before we get into it too in depth, but this gives you a high level overview of what a statement of cash flows looks like. We break it down into operating activities, investing activities, and financing activities. Operating activities are essentially the core operations of the company, whatever we're in business to do. Investing activities are those activities related to the purchase or sale of long-term assets. This could be investments, this could be property, plant, and equipment. Cash flows from financing activities generally involve long-term debt or equity transactions. And what you can see here is that the statement of cash flows allows us to say what was our beginning balance, what was the cash activity for this particular accounting period, and what do you know? We reconcile that back to the cash balance on the balance sheet. So what it essentially does, it's not quite as obvious here because this was a new business that started with a zero balance. But when you're actually looking at this for a big company, what it allows you to do is better understand that change in the cash balance that occurred. For example, large companies that file with the Securities and Exchange Commission have to file comparative balance sheets. That means anytime you pull up their consolidated balance sheet, you are going to see at least 2 years of information presented. So you are going to see last year's cash balance and you're going to see this year's cash balance. The statement of cash flow is essentially going to give you that reconciliation between the prior year balance and the current year balance so that you can understand what happened there. So I hope this helps to kind of clarify the flow of the financial statements.